Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have a guest speaker, John Schwinghamer. John is a portfolio manager at Scotia, and he has authored a book called The Purple Chips. John focuses on investing in high-quality stocks at low valuations. Paul, why don't you introduce our speaker?
Absolutely. John, welcome. How are you today?
I'm good. Thank you very much. Thanks for inviting me on the show.
Yeah, and before we start, the background, you're sitting in an unusual building. Tell us exactly where you are.
I'm actually in Nova Scotia right now on an island called the Briar Island, and one of your good followers, Mr. Haynes, has been here, in fact. And this is a church that I bought about 6 years ago, and we're converting into an artist residency. So you don't see the whole church, but you actually see the ceiling in the background, and it's an interesting church, built in 1850, and so I'm having a lot of fun with this. We're restoring the whole thing.
Wow, that's
Really
fantastic.
great project.
That's fantastic. I love stuff like that. So good to hear. Hopefully one day I get to visit it and see what it looks like. Well, great. Well, listen, John, purple chips. It's something that we don't know too much about, other than you're in an investment game, and you sort of look for high quality companies, and clearly it's a play off of blue chips. But why don't you tell us all about purple chips and what investors can look forward to if they visit the site?
Well, first of all, I'll start with the name. Okay, the name Purple Chips came about because I was looking for something a little bit better than blue chips, and so purple is the royal color, and purple chips are the royalty of blue chip stocks. So what we did was we came up with 3 simple criteria. Okay, we're looking for companies that have stable and predictable earnings. We're looking at companies that have at least 7 years of consistent growth in their earnings, and a certain size, so a market cap of at least $1 billion. And when you have those 3 criteria and just put a screen out, you eliminate about 96% of the listed companies. And so you end up with a very small group. And what we did is we took the 250 or so companies that we narrowed it down to, and we call these purple chips, because these are really the best large cap stocks that you can buy. And we look for certain hallmarks. It really boils down to earnings on these companies. And I know you're a big fan of talking about small caps with earnings and cash flow. And we do the same thing, but on on the scale for large cap companies. And what we look for is companies that have had consistent growth in their earnings, because when you see steady and predictable earnings lines over a long period of time, it can actually give you clues about the valuation of companies. And I think this is true for small caps, large caps, mid caps, I mean, everything. But it's more predictable for the large caps because you have so many players being involved in them. They're so liquid. You get a little bit less distortion, let's say. Mm-hmm. So anyway, so we narrowed it down, our search down to, our universe down to about 250 companies. And so we have a website called purplechips.com. And on that website, we actually show you the valuation ranges that we've established for these companies. And I'll give you an example. I'll see if I can just jump over to what I've got here on the website right now. And wait a second, I'm going to share my screen. Hold on. A little bit of a rookie at this, so. Okay, so I'm going to go to, I don't know if that worked. Are you seeing?
No, not yet, no.
Okay, okay, I think I'm going to have to drag this over. Sorry.
No worries.
Okay, I'm dragging this over. And I should be able to share this screen. There you go. Okay. So now I'm sharing with you one of the dashboards on the purplechips.com site. And what you're seeing is the companies that are out of our universe that have a low valuation right now. So those ones that are bright green are actually below their low valuation. So those are this is indicating that those are companies that we find interesting. And if you look at the names, I mean, it's stocks like, for example, some that you would know, Costco is on sale right now. Salesforce, Cisco, Cognizant, Danaher, Domino's Pizza. The ones with the little stars, by the way, are the top 20. So Home Depot is on sale right now. And if this wasn't at the low end of the valuation range, you wouldn't see it on this dashboard here. And then the ones that are in light green are within 5% of our low valuation target. So you can see there's a whole bunch of stocks there. And if I look at the names, it's companies like CVS, CSX, the railway, Broadcom, there's a whole bunch. Even Intel is on that. Microsoft, for example. Microsoft, we would be a buyer at 250, and the stock was around 258 today. So this is what you see on the dashboard of the website. But I'm going to show you now something else, which is a chart that is going to show you essentially what a purple chip is all about. So I'm going to go to this screen here. Okay, so now you should see a chart of Amgen. Okay, yeah, that's ticker AMGN. And what you're looking at is, this is a long-term chart. It's a 20-year chart. So it goes from August 2002 up to now. And in the top pane, we have a monthly bar chart. The yellow bars are the stock action, okay, the price action. The white bars, okay, that little step graph of white line there is the earnings per share. And that's the key. Okay, so this chart kind of summarizes why purple chips are interesting stocks. You have the white line is the earnings per share, the trailing 12 months earnings per share for the same period of time as the stock is listed there. Okay, so you've got 20 years of history of the earnings growth. And you can see it's very steady and predictable, and it's consistently growing over the long term. Okay, now the fun thing about this, and this is why I came about, why I actually wrote Purple Chips, why I wrote the book back in 2012, is because I saw the relationship between the price action of these companies, these top purple chip companies, and their earnings. Like, it became crystal clear when something was low value or high value. And like right now, I'm looking at this and I'm seeing that Amgen is kind of in the middle of its valuation range. Now, the top pane shows the bar chart of the stock with the earnings per share overlaid, okay? And the way this is set up, the earnings per share is actually tracking the last trade of the stock. So imagine for a second, okay, right now Amgen is trading around 252 roughly, I believe. 252. And so this white line is ending at 252. If Amgen was at 210, imagine that whole line being shifted down. And I can actually move this on this screen and you're going to see this, okay? So I'm going to grab this line and I'm going to move it down here, okay? So can you see what I just did? How I moved it down?
Sure.
Well, what's interesting about that is it actually coincides with all the interesting buying points in Amgen. If you notice, okay, back in 2011, let's see if I can put my cursor there. Okay, you see there was a bar that went down here and all the lows of the stock were pretty much in the shape of the earnings curve, okay? And the same thing going forward. As the earnings grew, the stock price kept growing too, but it still maintained the same relationship or the same shape as the earnings curve. And that's what's fun about this, is that when you understand that strong relationship between earnings and the price, then you realize that if the earnings accelerate then chances are the gyrations of the stock price are going to start accelerating in the same shape as the earnings curve. Okay. So anyhow, I don't want to get too technical about this, but this allows us to establish a low and a high valuation. Okay. So I would be a buyer of Amgen if it went to 230 or lower. And conversely, if Amgen, okay, I'm just shifting the earnings line upward here. If Amgen was, let's say, at 280 or 290, I would definitely be interested in selling it.
Yeah.
Okay. So I use that as a guide in how large to have a position. So we use 3 position sizes.
Yeah.
We go overweight, regular weight, and underweight. And what we do is when we buy these stocks, we always maintain a position. So our smallest position will be an underweight position. And what I learned over the years, which was really funny, is that sometimes when stocks get expensive, they can remain expensive for years. And so I used to sell them. Like when I wrote the book, I actually talked about taking profits, and I would just sell them and look for the next best thing. And then I stopped doing that because I realized I missed out on so much money. So I actually kept these smaller positions in these stocks, and those have actually become our biggest money makers. And I'll give you an example. We bought a stock called Constellation Software a while back, and we've owned it ever since, even though it's become very expensive. So we have a small position, and we didn't get a chance to go to regular weight or even overweight because the stock didn't get cheap. But we're making a pile of money on that stock that kept going up. And so when a stock is cheap in our universe, we buy it. And if it's cheap, we probably go to an overweight position. And like in Amgen, we actually have a pretty good sized position right now, and it's been doing very well. So despite the market challenges that we've seen in these tech stocks, large cap stocks, whatever, all stocks, in fact, this stock has actually done pretty well. So anyhow, that's kind of in a nutshell what Purple Chips is about.
Fantastic. What's the universe of stocks that you look at? Is it all of North America? Is it international? Is it just the US?
It's actually, for our purposes, it's North America, but the same logic applies to Europe or any of the global markets, as long as they're liquid. And, we've seen the same trends in European stocks too. And so we have a list of European stocks. It's just that it's a little harder to follow and to trade those stocks. Yeah. So we tend to use ADRs, the American Depository Receipts, to do those positions.
Yeah, well, that makes sense. And how do you, John? How did you sort of? Well, let's do this. Why don't we ask more about you? How did you get involved in investing?
Well, that's a good question. I probably like a lot of people. I didn't have any connections in this business. I started in '84 on the floor of the Montreal Exchange, and the Montreal Exchange had their first ever apprentice trading program. And I heard about this, and I just thought, wow, this is me. I had just graduated, and I really wanted to get in this business, but I didn't know anybody who was in this business. I didn't have any connections to get into the financial world and all that stuff. But the story is that about 2 years before that, I had lost a fair amount of my money, actually all of my money, in the market because of some unscrupulous broker that put me into warrants for some resource company, a little BS company. I lost everything, okay? And I remember getting the call. Actually, he didn't even call me. I called him. I said, so what happened to these warrants, that you said were going to go up? And the guy said, well, sorry, kid, they're not worth anything. And then I thought, wow, what just happened? And I had lost a pile of money. And because of that, I was so persistent that the Montreal Exchange had no choice. They had to hire me. So that's how I got into business. And so I got this crash course on investing and becoming a trader and all this stuff. And so that's how I got in. And then I basically went through the different levels of the business and became a portfolio manager about 14 years ago or so.
And how do you go from investing in, let's call it speculative warrants of all things, to large caps? I mean, it's quite the leap to get there.
It is a leap, and I guess it's evolution, because I started with a lot of sort of Mickey Mouse stocks that didn't have the basis for investment that I use today, and make enough mistakes and you realize you're doing something wrong, and it took a while, but I did learn a couple of things, and Purple Chips has been a real lifesaver for me, and it's been it's helped me out tremendously. So I'm very fortunate to have come up with this concept. And as I mentioned earlier in our discussion, we're actually working on the next iteration of Purple Chips also.
So let's talk about that. What does the next iteration look like?
Well,
what are you trying to do?
What I'm trying to do is get better performance with less drawdowns. Okay, and we've done a good job with Purple Chips. Okay, it's been better than market performance on a consistent basis. So in other words, we lose less when the market does badly, and we tend to make more, usually more, when the market does well. It's not always true, okay, but in general, we've outperformed, okay, on both sides, in terms of gains and in terms of minimizing losses. And keep in mind, the idea here is to make decent returns, and I'm not talking about shooting the lights out, because that's what you do, okay? When you get 10 baggers, we don't get 10 baggers, it's just not in our it's not a part of our reality. But we try to make decent returns, but with a low level of risk.
Right.
So that's the key. So this is the safe capital that gets invested in this stuff. So I mean, people, if you have lots and lots of money, usually you'll have a certain amount of small caps, a certain amount of large caps, and you do what you feel comfortable with. So this tends to be a little less risky. What we did with Purple Chips was we developed a very financial way of screening these companies, and we realized that sometimes you can have great companies and it can take years for them to get discovered, let's say, okay? And so we found that if we introduced a few different criteria, still putting the most emphasis on our financial criteria, which is smooth and predictable earnings, consistent growth in earnings, etc. If we use those as the basis, but we add a few things, like we added ESG considerations, okay? ESG being environmental, social, and governance. Okay, we added the ESG considerations, like how does a company rate on the ESG scale? How does a company rate on management effectiveness? So we came up with actually 9 criteria, okay, in total, and we screened a bunch of companies, and we were inspired actually by the Drucker Institute. I don't know if you ever heard of a guy called Peter Drucker in the States. So he's like a management guru.
Yeah.
And the Wall Street Journal one day carried an article about these Drucker companies, and they said that these guys outperformed over the long term, and it was true. So then we did more research on this, and we did our due diligence, and so we came up with these 9 criteria that include the Drucker management effectiveness criteria. They include ESG characteristics. They include the financial things that we look at, okay, like earnings growth. We look at PEG ratios. We look at free cash flow and things like this. And by putting this all together, we realized that we had something that was a notch above Purple Chips. And so we call this new iteration Deep Purple. We kind of like, we don't know where the name comes from, never heard it before, but, but I think it's got a nice ring.
Absolutely.
So,
I think Deep Blue, isn't Deep Blue like a big computer system or something like that? So
yeah,
like
that's right. That was the IBM.
That's right.
IBM computers.
Yeah. Deep Purple. Perfect. So so you mentioned a bunch of the criteria, but how do you determine like size? Is size one of the criteria? Because we've talked about large caps here versus small caps, but do you define where that is, or are you just looking at any company that meets sort of the 9 criteria?
Well, the screens that we're using, we're actually starting with the purple chips list, and we're including the Drucker Institute list, which is about 850 companies.
Okay.
And then we went through that 850 and we took out all the companies that didn't meet our financial criteria.
Mm-hmm.
So we narrowed it down. We narrowed it down to 100 companies on this deep purple list. Okay. Mm-hmm. And then we go a step further and we took the top 20 companies. And I'm going to show you the guts of our research here. Mm-hmm. I'm going to jump to the deep purple. So now you can see, you should be able to see a spreadsheet on your screen.
Sure, yeah.
Do you see a spreadsheet?
Sure.
Okay, so that's his top 20. And you can see the names there
mm-hmm.
in the top 20. Those are actually things like Google, Amazon, Best Buy, Home Depot, yeah. Target, et cetera, et cetera. Mm-hmm. So those 20 stocks are the top deep purple stocks, okay? Then you have a column that says price. You've got low valuation column. Mm-hmm. And the green is actually low valuation. So you can see a lot of those tech companies that have been killed lately are actually in the green. So like we think that Google and Amazon are a buy right now. So is Best Buy, so is Home Depot. Costco is now a buy. UPS is a buy. Owens Corning is within 5%. And last week, Owens Corning was a buy. Because last week, Owens Corning was about 85 or so. Microsoft was a buy this morning. Apple came very close to being a buy, and Adobe has been a buy for the last couple of weeks. Mm-hmm. And so what we did was we built a portfolio of these different types of companies in different sectors. And so we've got communications companies, consumer discretionary, consumer staples, financial services, healthcare, industrials, technology. We took the top companies in each one of those sectors. Okay, and the way we find the top companies is we actually have a scoring system for the number of points that they get based on the weightings that we assign to them. And these are the top scoring companies. So we use I don't want to get too technical, but we use a Z-score system to bring up the top companies. And then we have these 9 criteria that we look for. Mm-hmm. And we assign a total score. You'll see a column Y there. It says overall deep purple score, and that gives you the top companies in those sectors. And we found that by using those companies, I'm going to show you the performance. The deep purple performance was pretty spectacular. In the last 5 years or so, well, we back tested deep purple, so this is not audited, so just be aware of that. But basically the deep purple is down 14% year to date. Okay, but last year it had made 26%, the year before that 28%, 2019 41%, 2018 it made 0%. That was a year when the market was down. Actually the Dow was down 3%, the S&P was down 6%. And in 2017, Deep Purple would have made 39%. So those are pretty good numbers. And what I'm expecting is that going forward, if we can make 15% a year on average, then that's a pretty nice number. So that's what Deep Purple is all about.
Fantastic.
And purple chips.
Mm-hmm. And what do you find is the typical hold period for the stocks that sort of rise to the top here?
The typical hold period is probably several years. Mm-hmm. So when we buy something, it just the position size might change. We might go from overweight to regular weight to underweight, and then back to regular weight, then back to overweight. It'll vary as the valuation changes. Mm-hmm. So it's a very simple approach. Perhaps it doesn't sound that simple, but when you boil it all down, it's pretty simple. And there's not a huge amount of movement in the portfolio, but like the movement, it comes in the position sizes.
Right. Gotcha. So so you'll trim and add as sort of as a system sort of advises you. That makes sense.
Exactly.
That makes sense.
Yeah.
Do you ever get in a position where something goes really sideways and it just says, it spits out an answer and says get out, get out as fast as you can?
We do. Yeah, we
Yeah.
do. We do. Because what happens is we look at the earnings, okay, and our rule of thumb is basically if you've got 2 or 3 consistent or 2 or 3 quarters of declining earnings, and if we're looking ahead and we see that that picture is getting even worse, then we're going to get out because it no longer qualifies as a top company. There's going to be something better that we can replace it with. So we do take losses in things that go sideways to lower, and that's probably one of the biggest lifesavers that we have, because as you know, when you get a dog in your portfolio, the best thing is just to shoot it and move on.
Exactly. Yeah. Exactly.
Yeah.
Take it out back.
Yeah. Exactly.
Give us a sense when, like now, when it comes to managing a portfolio, how diversified do you want to see, people get with this program?
Well, there's a trend to be over diversified, and I think myself 20 stocks is enough. Like if you have a US portfolio, 20 stocks you don't need more than that. As long as you're in different sectors, you're good. And we have 10 stocks in our Canadian portfolio and 20 in the US portfolio. Okay. And that's enough.
Yeah. Yeah, for sure. Especially, the business of the size they're somewhat, I don't say diversified enough just because of the nature of how big they are and things like that.
Yes, that's right.
Yeah. How much attention do you pay to the macro? Interest rates are rising right now. Markets are selling off to some degree. How does that play into your sort of philosophy and action here?
Well, it makes a difference. There's been a massive rotation out of growth stocks and into value stocks. Now, last year we didn't look quite as good because our focus is on value stocks. The classic purple chips didn't have a huge amount of tech stocks in it, let's say. We had a lot of tech stocks on the list, but we didn't own a lot of tech stocks. And if you owned the wrong tech stocks, you could have been penalized quite a bit. So there's been this big rotation from from growth to value. So now we're seeing a lot of the Microsofts and the Amazons and all that stuff coming down. I think they went from like super expensive to becoming actually now very cheap. So we've gone very extreme in both ways. And that's the kind of market that it is.
So to some degree, you're a bit of a contrarian, right? Because if some of these things are sort of to meet kind of your criteria, they can't be momentum stocks, and they can't necessarily be, the hyper hot stock.
There has, definitely not the hyper hot stock. Yeah. Okay, so we wouldn't be going there. Like we never got into Pelotons or whatever. There's I won't say Zoom is a bad stock, but because it's actually building a pretty good business case, but it was certainly overvalued, and we didn't get into the Bitcoins and stuff like that. Right. They just didn't fit our model, Those were very risky. It was pretty hard to figure out what those things are worth. The Bitcoins or else the Bitcoin miners.
Exactly. Cannabis and a bunch of these other things, or
cannabis or the GameStops or.
Yeah, exactly. Listen, I want to remind everybody, if you've got some questions you'd like me to ask John, feel free to use the chat function as we have in the past. We do have a couple questions, John. Why don't we take a few as we go, and then I'll keep asking you questions as well here. So one of the questions is, how much bigger is overweight versus regular weight versus underweight? Can we sort of quantify that a little bit?
That's a good question. And the simple answer is our basic regular position is about 2.5%. Okay. We have 20 stocks in the US portfolio, and we allocate 50% of our capital to the US holdings. All right. So 50% divided by 20 stocks, that's 2.5%. Overweight is actually 50% more than regular weight. So we're talking about 3.5% roughly. Okay. And 3.75%. And then an underweight position would be 1.25%, which is 50% less. Right. So it's pretty easy. It's just 2.5 is your base, and then you're going up 50% or going down.
Yeah. No, good. And then cash. how much cash do you hold so it is ready to deploy? How do you manage with cash?
Cash is a tricky one, and that's where you were talking about looking at the macro aspect. And so when we don't like to have a lot of cash, because we found in the past that having too much cash really penalized us. Even though our portfolios did well, if we had 20% cash or something, that really reduced our returns. As a rule, I don't like to be, I always like to have a little bit of cash, 2, 3, 4, 5%, but then I don't want to have much more than 15% in cash, because if we're buying good quality stocks and if we like them and the valuations are cheap, we know there's a very good chance we'll be right with time. And that's the key. Yeah. Like all things, if you hold a good company, if you wait long enough, you'll make money.
I mean, these are all separate portfolios. You don't run the fund, do you?
Well, we manage the portfolios based. Everybody that's with us is running their portfolios. There's two types of. Yeah, they're running their own portfolio. So I mean, the subscribers that do Purple Chips basically do what they want, but they use our clues as to how to build their portfolio. And I end up talking to a lot of the people like you. We get close to our subscribers and we coach them and try to lead them in the right direction and try to stop people from betting the farm on one thing, let's say.
Sure.
Because that happened. So we try to help people like that. And the people that we manage money for at Scotia, they're basically on a plan. I'm a discretionary portfolio manager, and so I manage their capital based on the models that I have.
But no dreams of running your own fund one day and make it easy for everybody just to have you had all the headaches? No.
I've thought about that in the past, and it's kind of easy working for a big box like Scotia.
That's true.
No, maybe that's the wrong word. It's not easy, okay?
They handle more of the headaches. We'll just say they handle more of the headaches.
Yeah, well, I think that's it. Yeah, I think that's it. Now, I've been fortunate enough to have this business on the side, and they let me do it. A lot of firms wouldn't let me do it, but it was negotiated a long time ago when I joined them, and so they're still honoring the agreement, which is good. And and it also, it's a lot of people who were subscribers become clients.
Sure.
That's happened quite a few times, so that's a good thing too.
Yeah, for sure. Okay, a couple other questions here. Okay, we got one that says, are you hiring any analysts in your team? So are there any job openings?
No, there aren't any job openings right now, but you never know. Stay tuned. Yeah. And if someone has an interesting CV and they love doing this stuff, then they can certainly send me an email, and I'm willing to see how I can help them.
Absolutely. We've got a lot of keen members. So you never know, and some very, very bright people as well. So you might just get the CV here sooner or later.
Okay.
So the other question is, do you focus on timing the market? Again, back to the macro. Yeah, this is really sort of individual stocks that you're trying to time.
Yeah, and individual stocks. That's right. Timing the market is more of a general statement, and I found that I'm very bad at it.
Quite frankly, I don't know too many that are very good at it. A lot of people get famous because they get one call right, and then you forget about them after that pretty quickly. So it's pretty tough to time the market.
Well, Paul, I like to say that it's kind of like a broken clock, with those guys, and it's right twice a day.
Yeah, exactly. I agree. Okay, another question. How many years of historical data do you look at to determine whether earnings are predictable or not?
Well, our cutoff is 7 years.
Okay.
So, and the reason we chose 7 years is because we want to see a company go through a business cycle. And if you look at the last 7 years, I mean, we didn't see this coming, but when COVID happened, that was a real test for every company out there. because you had some that performed extremely well and some that got murdered in this.
Mhm.
So
Yeah,
I mean,
absolutely.
COVID was a perfect example of how can a company weather a storm.
Yeah, no kidding. Yeah, and then some. What let's talk individual stocks. Pick two or three of your sort of stocks you think everybody should be taking a good close look at right now.
Well, first of all, I mean, Amgen is a great company. It's not exactly cheap right now, but it pays a nice dividend. It's got a fairly low PE multiple. It's been a solid performer for years and years and years, and it will probably continue to be a solid performer. And unless we see some sort of degrading in the earnings profile, which I have not seen yet, it's been a steady performer for the last 20 years. And there's been plenty of opportunity in that. There's companies like Checkpoint Software, which is in the security, cybersecurity business. That's a big field. And on the Canadian side, we own CGI, for example. CGI, we wanted to add to our position. We were actually going to go to an overweight position when it was around $100, and I missed the window. It literally was a few days that there was a window there, and I didn't pull the trigger, unfortunately, and missed it. Now, anyway, now it's like 106, 107, something like that. CGI is a great company. We own Alimentation Couche-Tard. We own some Manulife. Manulife got hit the other day, but I think in the long run, Manulife's a pretty good deal, especially with rising interest rates. We own Home Depot. We own Adobe. We own some Google, which we're getting, it's not being very kind to us because it's in that whole area that's coming off. But in the bigger scheme of things, that's not going to hurt us very much. So there's a lot of companies, great companies out there, and they're not all cheap though. That's the thing. You know, we like to buy them when they're attractive.
Yeah, and they all seem to sooner or later get that opportunity to sort of fit that. So you mentioned Constellation Software earlier as sort of one of your stars, but is there any other names that come to mind that really performed well for you?
Yeah, well, actually, trying to think of the ones that really did well. I mean, Couche-Tard was on the Canadian side. Metro, Couche-Tard was great. CGI. We've owned Royal Bank for a while. I mean, Royal Bank's kind of a no-brainer. We own National Bank. We did super well on National Bank. I'm just trying to see here what would be. Hold on one second. On the Canadian side, I'll tell you our top stocks. If I look at our top 10 stocks, I mean, we own Dollarama. Dollarama has been fantastic for us. We own Richelieu Hardware, Couche-Tard, Metro, Royal, TD, Manulife, National Bank, Constellation, and CGI. Those are the 10 Canadian stocks that fit our Purple Chips profile. And then on the US side, we've got 20 stocks. And as I said, we're in the process of making a little bit of a rejig so that we're moving from the 20 core stocks that we had before into a different basket that's very similar and has a lot of the same names, but there's going to be a few names that we're going to change on the US side.
John, you and I have both been around the markets for quite a while. We've got a lot of sort of younger investors that are, well, relatively new to the industry. What's the one or two pieces of advice to give to somebody who has never really seen a down market, or is still trying to figure out how to make their way in the investment world here?
Well, down markets are a reality, and they do come around every once in a while. And if you've been in an up market for a long time, and it's been a bit of a fairy tale for the last few years, where we've had consistently growing PE multiples, and what's happening now is just normal. This is reversion to the mean. It's a lot of these companies are just becoming where they should be valued. And some of them have gone a little further, but that's this is just normal. And like if I always tell my kids about the housing market, what we've seen in the housing market, it's not going to last. Rates are rising, and trust me that housing prices will not continue rising. I know a lot of millennials think it's impossible. House prices always rise, but that's not true. I mean, anyway, that's my belief, is that the situation in housing will change in the next 10 years.
Yeah, the reversion to the mean. Yeah, exactly. I think yin and yang, you can call it a lot of different things. Bull markets are followed by bear markets, and then followed by bull markets again. So it's, I agree. I agree. Yeah. I mean, this has been great. And, I think I don't see any other questions here from anybody else. But is there, well, first off, the best way to get more information on Purple Chips, would it be to go to purplechips.com? Is that?
It is. Go to purplechips.com, and you can always reach me also. You can go on the site and send an email to info@purplechips, and it'll reach me. And I do respond to every email, and I try to do it very promptly. I'm not, even though I work for a bank, I'm not a banker. So, when people phone, I pick up, and a lot of my subscribers phone too. So, that's my policy is, if the phone rings, you don't, it doesn't go to voicemail. So.
Gotcha. So let me ask one more question in regards to, the church you're in right now. Are you swinging a hammer? Are you out there actually getting your hands dirty?
Paul, you have no idea. I can tell you, like, I have swung a hammer many times. And I guess it's kind of natural with a name like Schwinghamer.
I was going to say that, yeah. You got it. Yeah, absolutely.
Yeah. I don't have the skill to build this place, but I can certainly restore it, though. And I've got a whole crew of people that are working with me to help around here. So.
Oh, fantastic!
It's a great project.
No doubt. I think that's great. Great endeavor. Listen, sort of just, is there any key takeaway, any key message you want everybody to sort of walk away with today?
Well, I think the key message is that whether it's small cap, medium cap, or large cap, it always boils down to earnings. It's valuation, earnings, and cash flow. That's it. You want to be a good investor, focus on companies that have those attributes, and you'll be just fine. A good company that grows earnings will always perform well.
Completely agree. Yeah. Fantastic. Well, okay. Well, listen, we've been speaking with John Schwinghamer, the founder and manager of Purple Chips. For more information, purplechips.com. This has been great, John. We don't usually get to talk too much about large caps, or even sort of this sort of fundamental criteria around large caps. So it's been great to sort of get to know Purple Chips a little better, and certainly get to know you a little bit better. And we wish you well in all your endeavors, including your church renovations.
Thank you very much, Paul. It's been a pleasure for me too. It's been great. Excellent. And I love following small cap discoveries too. I think you I think you've got a great formula, and I love the fact that you keep getting those 10 baggers.
We'll keep trying. Well, hopefully enough to buy ourselves a church and see if we can do what you're doing. Yeah.
Very good. Thanks a lot, Paul. I appreciate it.
Thank you, John. Bye for now.
All right, then. Bye.